So there are two thoughts I would have on this. The first is, I like the Frank Knight classic distinction between risk and uncertainty. So risk is, right, we don't know what the outcome is going to be, but we do know all the definable distribution. So rolling a die or flipping a coin by that definition would be risky. Uncertainty, by contrast, is we don't know what the outcome is, but we actually don't know what the underlying distribution looks like. So distinguishing between those two things, I think, is a really good starting point. And it's an interesting question about markets. Would you deem it to be more risky, or would you deem it to be more uncertain? The mathematics we tend to use in finance, if you've ever used words like alpha or beta, right? You're using the language of risk, where you're suggesting that you understand what the underlying distribution looks like. But if there are elements, and maybe large elements of uncertainty, a lot of that language and that apparatus actually doesn't work well. The second thing I'll say is I really think that risk has a major temporal component. So, for example, a lot of value investors shun things like volatility as a measure of risk or standard deviation as a measure of risk, and I'm sympathetic to that point of view. That said, I think it's very time dependent. So for very short periods of time, I think volatility is actually a pretty good way to think about risk, right? So I have kids in college and I have to write a check for their tuition. Volatility is actually a very important concept for me. So I want to minimize my volatility so I can make sure that I can write that check. Or if you go out to an options desk and say to options traders, we're taking away your measures of implied volatility, they would actually be very much hamstrung. But as you take a long-term point of view, which I think most value investors do, then that idea of volatility melts away. And in fact, volatility becomes your friend, and risk then becomes the risk of loss of permanent capital. So I think that you can sort of bring these things under the same tent by thinking about that temporal dimension. So the way a long-term investor might think about risk would be, again, I don't want to lose my capital. I want to do things that are judicious. What tools may be separate? But for short-term investing, and by the way, all of us, because of life cycle, are both short-term and long-term, I think volatility is actually not a bad measure. So I'm a little bit more open about different ways of thinking about risk. But again, I think the key dimension is time.